So it's been nearly 2 weeks since the collapse of Silicon Valley Bank drove Signature Bank's downfall. We know that Signature Bank is a major lender to New York multifamily, so here's a quick check-in on where things stand now. The weekend before regulators seized Signature, real estate was already worried that the run on the bank that had toppled Signature might spread to other regional lenders. As we know, bank runs are driven primarily by emotion, so if people get freaked out and they think the bank might go under, they pull their deposits, and that could ensure that the bank does fall. So if the run caught on, clients worried other banks would be squeezed for cash and they wouldn't have the funds to make more loans. We know that some owners did yank their deposits from smaller banks as a safety precaution, but it seems as though the FDIC's backstops that insured deposits at Signature and Silicon Valley, they worked well enough to stop a larger run. So that's the good news. The question it left us with was what would happen to Signature's loan book. Signature didn't topple because it had made bad loans, but the quality of those loans and the assets they covered could make selling them off a trickier business. Signature was one of the largest lenders to rent-stabilized multifamily, which has seen valuations plummet since the 2019 rent law. Market values for these properties are believed to have fallen between 20 to 65%, according to Maverick Real Estate Partners. And at the same time, inflation has driven up operating costs. That's maintenance, insurance, utilities are all higher, and owners are still carrying a lot of back rent from COVID from tenants who haven't paid. So all combined, it's a perfect storm for properties to be underwater, if not now, soon. And then all came into play on Monday when we learned that New York Community Bank would take on Signature Bank's deposits, all of them, but only $12.9 billion of its $74 billion lending portfolio. Critically, that portion did not include $35 billion worth of commercial real estate loans. So there are a few theories as to why New York Community Bank snubbed those CRE loans. One is that it already had a lot of them on its books. New York Community Bank is the largest lender to rent-stabilized multifamily, so it's possible it just did not want to become overweighted in that category. The other possibility is that the bank didn't want more loans made at the ultra-low interest rates we saw before the Fed started hiking rates in 2022. But the more grave theory among industry folks is that New York Community Bank didn't take on Signature's multifamily portfolio because many of those loans are likely bad. They primarily cover rent-stabilized assets, which we know are grappling with distress. And while Signature reported nearly no delinquencies last year, so less than 1% of its $19.5 million multifamily portfolio was past due, it's possible many of those loans will run into trouble in the near future. So what we're looking at now is two things. Who buys those loans and what will it mean for borrowers? It seems like regulators will do one of two things, either sell the portfolio in full to another bank or piecemeal to several buyers. So for any borrower who's current on their loan, that sale likely won't make any difference. Who it is going to affect is borrowers who are delinquent. Signature and New York Community Bank were both deeply familiar with the rent-stabilized product, and they had long-lasting relationships with many of their clients. A bigger bank who is less familiar with the stabilized market may be less willing to pursue workouts. They could be more aggressive with foreclosures. And as Chips J. Martin put it, the longer those loans are out there, the longer they grow hair on them, meaning the less attractive they become to a potential buyer.